For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. I'm going to break each one into a smaller video just so it's more easily digestible. And then your homework would be to study your templates. That's what will allow you to, again, identify in your session, wherever you're located on the globe, to have a high probability opportunity rather than just focusing on, the same instrument and trying to trade the direction you think it's going, which can lead to frustration, inconsistency, sometimes impulsive, irrational behavior. And again, understanding if you're trading multiple sessions, not a problem, but making sure that you have setups. We'll talk a bit about order flow and consolidation of volume. My specific approach within the day count, my thesis, how I form my thesis when I'm looking for trade opportunities. And again, 90% of my trades are probably short, being done in the hour that the trade happens itself. So what that means is the trade should be over and done with within an hour. It doesn't mean that I'm only at the screen for 1 hour. I might be at the screen for 3 hours. An hour prep, an hour in the trade, and then, or whatever, 2 hours. The trade itself will often be over, in many cases, in 15 to 30 minutes. It's about identifying opportunities where the market is about to explode or potentially be in the underlying direction within that time frame, depending on the thesis, the template. And then again, not trading in front of the news. I never trade in front of the news. But I will trade after the news, and I'll just re-highlight that. Well, I guess I'll have to make that a bit smaller. So lots of traders, I know will risk trading the news itself. I don't really care what anybody else does. I don't care what anybody else thinks. I do not trade in front of the news. This is what I do. This is all I'm talking about is the trades that I take, my approach to the markets, and how this may help you. You don't have to trade exactly the same, but it may help you, number one, stay out of garbage markets, stay away from markets that are designed or days that are designed to chop you up, to whipsaw you, to get you caught in both directions and get you frustrated and engaging in impulsive, irrational behavior. It's about identifying, when you know what you're looking for. And I've heard other traders start talking about setups, and again, that's not a setup. They're talking still about trading moves in the market, chasing moves. I'm talking about very specific, cookie cutter, reproducible, rinse and repeat, scalable trade setups. Okay, so first of all, we start the week on a Monday. No matter what, my book starts clean. I don't hold stuff over the weekends. I don't hold stuff overnight. I'm in the market during my session and I'm done. I take my trade, I get off the screen. Monday starts the week. Now I want people to understand that this is the process that when I come to the screen allows me to scan through instruments to identify an instrument that has a trade setup. So for the people out there who say, oh, this is great, I can put a chart up and review it and everything else, let's see that, and I'm open to learning more and making more money. But if you don't have a process, if you're just talking about reviewing stuff, that's completely different from actually having a process that you can take each day, Monday to Friday, and understand where you are at in the template and how that template relates to a setup, and how whether or not in that session you have a setup, and then is that setup just a scalp for the session, or is that a sizable setup? What is the potential opportunity in that instrument. For example, oil obviously is going to be a lot different than the Canadian dollar in terms of its volatility. These are all the pieces of the puzzle, and then the timings. Everything is timed and measured. I've talked about 3 levels of rise. I've talked about level 3, level 1. We'll review those in future videos. This series is going to be specifically about covering the week on all of these instruments. And then your homework will be to go back and go through the weeks and then understand how to perform the count, and then look at your session and then understand whether or not there was a setup in that session based on the count, the template, and what type of setup it was. So when we look at the Canadian dollar, we have the previous week's high. So again, we talked about 3 weeks of rise. We'll specifically address that in a future video as well, but for this purposes of this series, again, day 1, Monday. Mondays are day 1. Now, whenever longs or shorts are triggered at the break of a high or a low, I call that day 1. Day 1 long. Now, Monday starts the week, and there's been some confusion from traders. I still don't understand how you can have Wednesday's a day 1, and so we're going to clarify that. Any day that breaks out, you now have longs or shorts in the market. The beginning of the week, we can have a second day trade. So we had longs triggered on the Friday. But in the new week, we have longs triggered at not only the high of Friday, but the high of the week. So you need to psychologically understand what's happened. Traders are trading this at the high of the week. If this reverses back down below the breakout of Friday and the high of the week, guess what? We now have another phrase that I keep mentioning that people say they don't understand. It's trapped volume. Now, more specifically, in our new 100 pip box, we have 3 levels of rise: 25, 50, and 75. Now, I had traders email me and say it was 5 levels of rise and 6 levels of rise. And every time we go into a new box, a new day, or a new timing window, I'm looking at where we're at in the current 100 pip box. We go up 3 levels. All of this volume, the higher that it goes, is trading higher and higher with space underneath. We go above 50 in the upper third quarter. Go back to my previous videos talking about the 100 pip box. We have a box of volume on the third level caught above 50 on day 1. Day 1 longs are in the market. We have breakout traders in the market. So again, for London traders that hung around in the gap, they had an opportunity for the short trade. But most importantly, understanding day 1 longs are in the market. What that means is that longs are in the market. You've heard me use the expression, nobody gets a free lunch. Short trade in the London session into the US window. You do not want to counter trend this market. So the only trade you could be looking at in the US session is a short trade. Now again, talking about this is a breakdown right at the beginning of the US 12 candle window for a low-hanging fruit trade. The low-hanging fruit are all the higher level longs caught chasing this move on the way up. You'll notice this pump up from Friday night, all the longs are buying at 25 or above. That's the low-hanging fruit trade. So again, we have volume trapped up high. Day 1, level 1 breakout traders are in the market. That's day 1 longs. Now this is where the templates get interesting. The next day, Tuesday, day 2, if we're working again from the high and the low, if you're inside, you need to know that you're trading in the direction of the underlying trend. We come down 3 levels from 75 to 50, 50 to 25, 25 to double zeros, and we put a low in place. So notice again where the lows are. Although we have the low of the day down here, they're trapping volume above the zeros. And I want you to think about things. If they're going to go the other way, they will often trigger breakouts in the wrong direction first. Again, we have another phrase. We have breakout traders triggered into the market at the low of day 2. You've heard me talk about another phrase called the initial balance. We'll put Tuesday, initial balance. So by the time Monday and Tuesday have traded, the high and the low for the current week are established. And what that means is that if you need to read more on initial balance, Google it, Google Dalton. What that means is that in most circumstances, one of those extremes will tend to hold for the week. So again, coming back to our session bias, you're paying attention to where peak formations are in the U.S. session into the close. They're up. Peak formations are up. So what that means is if you're trading Asia, this is the new U.S. lower high of the day. So if you're looking for a buy low opportunity, number one, we're inside here of the high and the low. Peak formation low, peak formation high, and then consolidation inside. So this is the rationale that I'm looking at each and every session. 45 minutes to the high at the end of the Asian window, the breakdown, and then the collapse. We now have breakout traders in the market. So to me, this is nothing. But this triggers the low of the week. We're in a box of volume below double zeros. This is the 25 to 50 pip false break outside of the double zero box. So remember, I say that over and over again. Most stop hunts are 25 to 50 pips. Now, obviously, higher volatility instruments, NASDAQ, S&P, gold may go 3 levels. But that's not a false break. That's usually a peak formation high or low. So we have a 25 pip box that reverses in our gap heading into the U.S. session. 3 levels of drop, trap volume, trigger breakouts, reversal trade into the U.S. session for the continuation trend trade back towards the high of the week. We now have day 2 longs in the market. Day 1 longs, so remember, day 1, if this is our day 1 breakout, stops are below Friday. Day 2 longs, stops are now below day 2. Well, just for visual sake, I'll put a green line below day 2. Day 1, day 2. So coming back to what I talked about in previous videos, just a standard sort of day 1, day 2, day 3. This is sort of the thesis with the basic template. Day 1, day 2, day 3 for a high of the week short trade for a larger scalable trade versus high of the day session scalps. Odds of your success on a trade increase on day 2 on a reversal, and day 3 super high in a normal template. Day 1, if it's a runner, we don't want to counter trend a strong market, and if there is a setup, expect that it may only be a session scalp, 25 pips roughly. Now we'll look at some subtle variations because we can get a day 1 breakout previous week that forms a peak formation on day 1, takes out the high of the day, as we saw on gold, and day 2 can be a day back down, and the count starts again now. That's our high of the week on day 2, our low of the week on day 1. There's our high and low, but traders are triggered long on the high of the day, but we actually are still inside of the previous day's high from day 1, which is Friday, if that makes sense. We'll look at an example of that. So you have to understand who's trapped, especially at the beginning of the week. So we've had low-hanging fruit trade on Monday on the Canadian dollar. There may have Asian shorts maybe in the Asian session. They may have shorted the high of the day back to the low of the week. We had long trend trade on day 2 back to the high of the week, day 2 longs. Traders who shorted the London session got a 25 pip low-hanging fruit trade back through the low of the week, but then again understanding not to be holding on to this. Obviously, if it goes sideways, after the 25 pip move, you're now in a reversal situation on day 2. So day 1 and day 2, critical to understand that forms our high and low range on a normal week. If we have day 1, day 2 extended out, that's different. We'll look at examples of those in the other instruments. But just coming back to day 1, first day, longs are in the market. Day 2 is a buy low trend trade back to the high of the week. Day 3 typically will blow off in the direction of the trend. Day 2, trend trade back towards the high of the day, the high of the week in the London session for a 25 pip plus move that continues into the US session. Now, news on the calendar will affect this. I can see wicks, but understanding, just graying out a lot of the noise and focusing on the levels. Okay, we're at the high of the week. We're 25 pips above the double zeros. Thesis is always, first hour makes a high and a low. I may get something up at the high of the day on day 3. So timing, 1 hour makes the high and low, second hour traps volume, third hour locks in the high, and then I talk about don't focus on all the garbage, understand the timing. Third hour opens up, 15 minutes, false move. It's the level. We're 25 pips above the 100 pip box. We're 50 pips above the longs from the London breakout. So I know people talk about all these different things, liquidity gaps and runs and value gaps, and people ask me, what do I think of this and what do I think of that? I don't think about that. I don't even know about it. I have no idea what they're talking about. I'm talking about 3 levels of rise, the high of the day. First hour makes a high and a low. Second hour hits the stops and traps volume up high. Third hour locks the high in, 15-minute false break for a 50 pip short trade back into traders who were long at the beginning of the London session. It's as simple as that. A day 3 high of the day short trade. Day 1 longs, day 2 longs, day 3 longs are up in the market. We have breakout traders. We've triggered the previous day's high. We're 25 pips above the double zeros. I may get something between 25 and 50. They put peak formations in. 1 push, 2 push, 3 push. Third hour opens up. Third hour, it's about the timings, the levels, and the setup. So the next big thing on the calendar is non-farm payrolls on the Friday. So we have 3 days of rise. We have trap volume above 50, between 75 and 50. We have peak formations above 75 up to double zeros, heading into non-farm payrolls Friday. Now, understanding that template that we went over in that first part, again, day 1, day 2, day 3, possibly for a reversal setup. Trap volume up high, peak formations for a fast explosive move down, and how news can be used as a catalyst or a potential trap prior to that move taking place. So again, if we're up high on day 3 or day 4, and our thesis is that the market is going to go down, we have news. Again, I emphasize, I do not trade the news itself. I wait for the news, and then having that thesis in place, still waiting for that vertical move for the short trade to come together for that move off of numbers or at a level. That move can happen inside of a level after the volatility for an explosive or a collapsing trade entry. So we talk about letting the news trade, having a level, and then understanding about after the news, the thesis being the market needs to give me a peak formation, locking in that high to enter that market, control my risk, and have asymmetrical risk reward, meaning 2, 3, 4R in a high probability short trade setup. Thesis being, again, the collapsing market underneath the trap volume. If we can't get in at 50 because of the news, We're going to get in when the market pulls back up into that peak formation that the non-farm payrolls candle gave us. So again, template, thesis, timings, best trade setup, asymmetrical risk reward, take the trade and get off the screen. So there's your Canadian dollar for the week. Day 1, day 2, day 3. News catalyst, trade thesis, short trade collapsing market, levels, risk control, profit target, get off the screen. Keep it simple, traders. We'll see you in the next video.